Welcome back. Chapter 10, page 3. We're going to do some examples of exchanging non-monetary assets. So, we are going to trade in a used machine for a new model. The machine given up has a cost of $12,000 and accumulated depreciation of 4, not depression. Its fair value is $6,000. Okay, we're given a fair value. It is traded for a new model that has a list price of $16,000. A trade-in allowance of $9,000 is given for the old machine. And we want you to record the entry for the exchange. First of all, this is critical because I see this all the time being misinterpreted. Trade-in allowance. If you go get a trade-in allowance, you trade in your car for a new car. What does that trade-in allowance mean? Let's say they give you $10,000. It means you take $10,000 off the price of the new car, right? So you only use the trade-in allowance, and I can't stress that enough because people always try and put trade-in allowance into the entry. Nope. Trade-in allowance, only use it to calculate the amount paid on the new asset. And that's it. Do that and then forget it. So, before we can actually do the entry, and again, you guys, you can take shortcuts on this and stuff. I'm doing it all so that if you look at it later and you go, why did we do that? It's there. So first I want to ask, how much cash? A lot or a little? And what's the dollar value we're paying? Now you notice it doesn't say you paid cash. You assume cash if they don't tell you anything else. And usually they only tell you the cash if some's cash and some's on a loan. Okay, so first, how much cash? Well, what's the price of the new machine? $16,000. And what's your trade-in? $9,000. So what are you short? $7,000. Okay, does that make sense? Okay. So, this is a non-monetary exchange. We're exchanging one machine for another. Now, this is a significant amount of cash. $7,000 out of the 16, so that's almost half. So this implies, or let's say takeout implies, gives more weight to treating it like a monetary transaction. But we have to check the conditions. There were two conditions. Is there commercial substance, and are the fair values available? So yes, the fair value is available. So let's write that down. And is there commercial substance? Well, what are we giving up? A used machine. What are we getting? The new model. Will that change the cash flows? Will it change the efficiency? Will it make a difference in our business? Yeah, it will. Fair value and commercial substance. because it's going to be more efficient with a new machine. So we can record the asset at fair value and record a gain or a loss. Okay, so that's the thinking behind it. We can record it at fair value and a gain or a loss. So let's break it into three kind of pieces here, and the entry will be over here. So first, we need to know the fair value of the assets given up. Fair value of assets given up, because that's going to be our new machine's value. So what did we give up? Well, we gave up some cash for $7,000. We gave up the old machine, and what was that? We have to record the fair value. Well, we don't care about the cost, we don't care about the depreciation, we care about the fair value. That's $6,000. So that's $13,000. And that's going to be the value of the new asset. Okay, now we're going to record the gain or the loss calculation. We take the fair value, and these formulas are all on the previous page. Fair value of assets given up minus the carrying value of assets given up. So the fair value of the assets given up was the old machine. $6,000 minus the carrying value of the asset given up. 12 minus 4 equals 8,000. So we should have a $2,000 loss. Okay, and as I said, you guys don't have to do this calculation here. You can also just do the entry and fill in the blank. Okay, now we've got to debits, credits, and see where everything goes. So put this on pause, try and fill it out, and then when you've got it done, come on back and we'll check if you got it right. Okay, so we've got a new machine. $13,000. Now, what did we give away? Well, we gave away the old machine, which on its books was cost, so it's $12,000. And what do we have to close? The accumulated depreciation of $1,000. Now, is there anything else we gave up? Cash. Okay, last thing you do is give it balances. 12 and 19, that's 17. So we're short by 2,000. It's a debit, so it's a loss on sale. Okay, so that was one example. Now let's do another one. So we exchanged used trucks plus cash for land. Trucks have a combined cost of $64,000 less accumulated depreciation of $22,000. Trucks have a fair value of $49,000, and we pay $4,000 cash. We want the entry for the exchange. Okay, so they already told us how much cash. We didn't have to calculate it using the trade-in allowance like we did there. So the next question is commercial substance. Actually, before that, let's just see amount of cash, how much it is. $4,000 versus the land. Seeing as we're going with fair value of $49,000 and stuff like that, that seems pretty low. So it's low. Definitely non-monetary exchange. So now we just have to test it. Is there commercial substance in fair values? So fair value is available. And is there commercial substance? And yes, there's commercial substance. Now, why might I say there's commercial substance? Well, land versus trucks will give different flows. Okay? The reason this whole rule came about commercial substance having to be there, so you'd record it at fair value instead of carrying value. What happened was in, the 70s, 1970s, yeah, none of you guys were alive, and I was just very young. Companies, right, everybody records buildings at cost. So real estate companies, developers, and just any companies that own buildings had these buildings sitting on their books. Well, it was a period of higher inflation, and so the prices of the buildings rose rapidly, the value, the fair value. But there was no rule that said, you can just write it to fair value. So what they did was, let's say you had two companies across the street from each other, and both of them had a big office tower. What they would do is they would sell them to each other, because remember, when you buy an asset, you record it at fair value, right? So all of a sudden they each other's assets and they'd put it on their books and it would be a fair value. So instead of being $1 million, it's worth 15 million. Okay? Because everything went up quickly, and same with the land. So all of a sudden companies were, by not changing anything really, increasing their balance sheets. So their property, plant, and equipment looked a lot better. So that's when accountants came up with this rule that said, you know what, if you're just flipping assets to make your balance sheet better, that's just not right. So if you are trading like assets for like assets and nothing's changing, there's no commercial substance, you can't write it at fair. You have to write it at carrying value. That's where this rule's coming from. So when we're looking at changing used trucks plus cash for land, you're saying, there's commercial substance there. They're doing something differently. Their business operations are going to change. Okay? Okay, so therefore, we can record a new asset at fair value and record a gain or loss. Oh, and of course, the companies that were trading back and forth, the same type buildings, they were recording on their income statement as well, huge gains. So they were looking great. And that's why the accounting profession just said, whoa, well, that's not right. You're misleading investors and so on. Okay, so let's do our little pieces here. I think we can split them up the same way. So, fair value of assets given up. Trucks. Cash, very small percent, 10%. 53,000 is going to be your value of the new asset. Now the gain or loss, which again you don't have to calculate, it's just they show this in the textbook and I wanted you to understand it, what's happening. So fair value of given up, asset given up, minus carrying of asset given up. So that's going to be 49,000 minus 64,000 minus 22,000 gives us 7,000 as a gain. Okay, let's do our entries. Again, just take a little pause and put it together. Okay, so we are getting land. The value we already know, we calculated, is 53,000. We go away trucks and cash. The trucks are 64,000 and the cash is 4,000. What do I have to close? Accumulated depreciation on the truck, which is 22,000. Okay, so what should we be short? A credit of 7,000, and are we? Sure. I can't do math in my head when I'm recording. Too stressful. So 7,000, and that's going to be your gain on exchange or sale or disposal or whatever. Okay, so hopefully that made sense, you guys. Make sure you try these before you hop to the suggested problems. It'll help. Or if you're trying the suggested, actually, because you don't, if you've got it, right? It's fairly straightforward. So go to the suggested problems and stuff. If you're having trouble, come back and try it again. Okay, we will go on to page 4 in the next video.